global favorites for United States, but by the time we hit the middle of the year, very clearly we were not. And the markets actually played quite truant in and around this theme as and when the news flow came through. So in that context, in my opinion, we will go from trade conflicts in CY25 to deal making in CY26. While we may debate, the pace of it, the shape and size of it, and the timing of it, it's very clear that directionally both the economies are looking to resolve their differences and ultimately lead to a common ground. I'm confident or hopeful that in the next 12 odd months, we will see a more clarity on this fashion, and this will be macro-wise a positive for India. While Indo-US trade relations and the deal generally is a central focus for the market, in my opinion, of equal importance is how we de-risk our trade partners. This year, we saw the first one, which is India-UK trade deal come through, which in the grand scheme of things is small. But some of the bigger ones like India, EU, or maybe India, Japan, or some of the other nations might be more interesting. And in my opinion, over the next 12 months, you will see some semblance of that coming through as well. This will have not only might be more interesting positives, which are in my opinion, over the next 12 months, you will see some relief to the otherwise the connotation that India, an old trading partner, which the United States are now no more together. This will also give people the sense that we have been able to diversify our trading block in such a way that going forward, our trade basket is more de-risked in that context. So certainly would be a positive in the context of India. The second thing that I see is, the beginning of earnings upgrade cycle in India. For the first time in the last 12 to 15 months, we saw a marginal of about 2 to 3% earnings upgrade come through in September quarter. This is, of course, on the back of significant amount of effort by the government and also macro situation changing. Significant impact of government moves include GST reforms, tax cut, and interest rate cuts. And on the other side, macro help included crude oil falling meaningfully, and also the fact that inflation cooled off meaningfully. All of that meant more discretionary income in the hands of consumers, and hence for the first time, less so in numbers, but more so in commentary, at least the outlook of consumer discretionary companies and in general improved, which was languishing over the last 2 or 3 quarters. So very clearly from that perspective, I do see the beginning of the earnings upgrade cycle as a turning point over the last 12 to 15 months, which is something that has been lacking from an Indian market's mojo standpoint, if I may say so, relative to the globe. This year, while India's earnings saw a cut of about 10 to 12%, some of the other countries which were seen as AI beneficiaries saw earnings upgrades meaningfully, and that made those countries outperform. So over the next 6 to 12 months, as India's upgrade cycle starts and hopefully it sustains, we will see better relative performance for India as well. That's the second theme, in my opinion, which is the beginning of earnings upgrade cycle for India. We will see better relative to watch out how at what page it continues, and theme, how long it continues, and the beginning of earnings upgrade cycle, which will form a hypothesis on this as time goes by. But the starting point, global rebalancing of power. I think I've quoted myself in multiple places where, in my opinion, the global balance of power is shifting from a pure US-centric world to a pure multipolar kind of a world scenario, wherein multiple economies are going to share the podium, India being one of them. This will genuinely benefit India from a medium to long-term standpoint as we make the journey from 5th largest economy to the 3rd largest economy in the world, in the sense that overall, from a cost of capital from India's standpoint, will ultimately come down over a period of time. All of these three things will kind of manifest themselves in the form of equity markets over the next 6 to 12 months, which I think directionally is positive. From a practicing fund manager standpoint, of course, the most relevant and important part of managing India dominant portfolios are how do we play the earnings upgrade cycle of India, which will be the sector leaders and which will be the sector laggards. If you ask me, one of the sector leaders would clearly be consumer discretionary. That's something as an area we are positive on. Since the beginning of calendar year 25, we've also launched a consumption fund, which we discussed last time, which has done quite well. And with the 8th pay commission in front of us, we think it has more to go. So clearly, consumer discretionary as a sector is something that we are positive on. The second sector, which we have not talked about too much, is in the early signs of turnaround, and we would cover more details of it, is the financial services sector. Two parts to our thinking on financial services sector. First, the fact that as rate cuts have happened over the last 6 to 12 months of about 100 basis points, there will clearly be beneficiaries within the sector which would actually see the better times to come through. But the second part of it is more what makes, in my opinion, life more interesting. And Ashwini will cover in a lot more detail, which is the turnaround in the credit growth of the economy. Credit growth last year late was somewhere around 17 to 18%, which has been languishing at about 8 to 9% over the last 3 to 6 months. I think for reasons which Ashwini will elaborate on more detail, our sense is that this 8 to 9% might actually turn around to more in double-digit scenario over the next 12 to 15 months. As that happens, financials as a broad-based sector, and certainly within financials, NBFCs would see better days ahead. More in depth coming from Ashwini, both the cyclical as well as the structural case of financials. That's the second sector that we are positive on. Third is basically a relatively contra view, which is on IT. Now, it's not that versus benchmark, we are massively overweight in the sector. We'll probably be broadly neutral, maybe marginally overweight in this spot. But versus competition, our view is that a lot of bad news or negative sentiment in the form of macro and in the form of weak deal flow, in the form of earnings estimates are kind of in the price. So relatively, we are a little more sanguine on IT going forward. Not that we expect miracles to come through in the near term. If anything, the immediate quarter is a furlough quarter, so likely to be slow. But I think the valuations are reasonable. If you give it at about 12 to 15 month time, there might be better days ahead. So all of these are the sectors that we are overweight on. The final bit I would say is on government spending place, but more specifically with regards to defense and a few areas within infrastructure. That kind of sums up our portfolio positioning across different sectors. The key highlight, as I've been telling, are two sectors. One that we covered last time, which is the consumption sector, and how that is already witnessing some of the better days in the form of spending patterns and also expected to go forward. And second sector, which we will cover in more depth today, is financial services sector. Overall, in terms of where we are and where we are headed. To talk about this, let me introduce Ashwini, who has been part of my team for a good 3 to 4 years now. He has been looking at financials close to 20 years now. So as good an expert as we can think about on the financial services sector. He also manages the ELSS fund, which has also done quite well on the back of his financials expertise as reflected in the portfolio as well. So as I pass on the mic to Ashwini, let me lead on with the question that, Ashwini, where do you see the financial sector is today? What would be your sectoral outlook going forward? And would you recommend investors who are looking to take a thematic view on Indian equities to look at financial services sector as well or not? That will be obviously followed by your thinking on the ELSS portfolio. Over to Ashwini.
Thanks a lot, Siddhi, for the introduction. Good evening, everyone. So I'll answer all your questions. First, let me go through the flow of the presentation, that how I want to do it. I'll take you through the BFSI sector, how we are positioned in the business and the market cycle. And then I will talk about the ELSS fund. Within the fund, I'll talk about our investment process, the current themes and positioning as we talked about, and the performance of the fund. Starting with my PPT. Yep. Are the slides visible? Yeah. So
Yes, please.
If you look at the credit growth, currently our credit growth is roughly 11 11%, and the chart on the extreme right hand side. It peaked out around about February 23, where the growth was roughly 17-18%, and it was helped by both benign base and strong demand. Currently, our overall credit would stand at roughly 195 trillion rupees, which is roughly 60% of the GDP, and the total deposit is roughly 240 trillion rupees. Current LD ratio would be in the range of 79 to 80%. At that point of time, right from Jan 2020 till February, March 2023, we had immense liquidity in the system. At some point, the liquidity was as high as 6 lakhs to 7 lakh crores. This demand in credit was well broad-based. It was supported by both SME, MSME, retail category, and somewhat in the corporate credit as well. But the large corporates were still not there. After that, there was interest rate hikes, roughly to the tune of roughly 200 basis points. The liquidity, which was positive, turned to 3 lakh crore negative. And RBI nudged all the banks and NBFCs to go slow on the retail credit, on the MSME, SME credit, because there were some symptoms or signs of over leveraging in the system. Even the MFI segment, which was made to cool down. So whatever a slowdown which we see or which we have witnessed in the last 18 months is not cyclical. It was self-imposed for better regulation to prevent bigger accidents happening going forward. This overall loan growth had come down from the highs of 17% to 9% 3-4 months back, and now currently it's hovering at 11%. And from here onwards, it will improve back on both increase in demand and base effects. Right now, even the liquidity has become positive since March last year. We are hovering around 2 lakh crores of 20 years, how the banking system has evolved. If you look at the green area, which is the agriculture and the allied activities, it has remained significantly in this range bound category between 10 to 12%. It is the gray area which has come down. If you look at it, used to be roughly 50% at the start of 2005, and then it peaked out in roughly Feb or March 2013. And post that, it has been on a one-way trend, and that is downwards. This is the industry. Right now, industry is only 30% of the total credit, and the segment which has grown is the services and the retail category. If you look at right from the start, retail and services put together would be 45% of the industry, anything between 45 to 50%. Now they are roughly 65 to 70% of the total banking sector credit. Out of total 195 trillion rupees, roughly 65 to 70% has gone into these two segments. And within these two segments, it is basically NBFCs, housing, vehicle finance, personal loans, jewelries. These are the sectors which have driven demand right from 2013 onwards. Now, again, if you look at this chart, look at the chart on the left-hand side, the credit cycle or the stress in the credit cycle peaked in 2018, where the entire system made losses to the tune of roughly the ROA was negative 3%, negative 0.3%, 0.2%. In FY20, it was just flattish at 0.0%. It was slightly on the negative side, but it's not been captured. And the GNPAs, if you looked at, was roughly 11.5%, 11.2% to be precise, and roughly 9%. So in the last 12 years, we have made a provision of roughly 26 lakh crores to provide for the bad loans. And the total profitability of the system was 10 lakh crores for the last 10 years put together. So if you can relate to the amount of NPA which was created due to both judicial interference and bad underwriting, and how much the banking system had provided for. Now, if you look at from 2020, things started to improve from 2020. Most of the banks garnered equity capital from the markets, or the government gave capital to the PSU banks. And post that, there were no bad loan creations, and the ROAs have inched up gradually back to the normalized levels of 1.3% again. So these ROAs are best in a decade, which I have seen, rather 15 years. These ROAs are best in the last 15 years. And at the same time, the gross NPAs, which were as high as 11.2%, has come down to 2.3% and further down in FY26. I expect the ROAs to continue to be here at roughly 1.3%, 1.2%, gross NPAs to come down furthermore in FY27 as well, because the loan growth has been in retail category, which is less chunky, more granular in nature, and you don't see a herd behavior in that category. Now, we have talked a lot about that. We have become leveraged, and there was a lot of overheating in the personal category. Now, let's look at the chart on the left-hand side. Now, we look at the big daddy, the US. The overall household debt as a percentage of GDP in the US was roughly 78% in FY15. It has come down to 69.2%. At that same point of time, we were at 32.9%. And despite all the noise about the increased leverage, by December 24, the data is available, we are still at 42%. And then China has been growing continuously. In FY15, they were slightly ahead of us. Their household to GDP was roughly 35.7%, give or take 3% higher than us. Today, they are roughly 19% higher than us. They are at 60%, and their economy or the banking system is not doing great. Euro has come down from 59% or 59.5% to 51%, but it's still roughly 10% higher than us. And there, in Euro, the population is aging and the economic growth is tepid, so not a great story. So overall, if you see India, both on absolute basis or relative basis, we are on a very, very strong footing. We have got only 23% of the people, I'm referring to the chart on the right-hand side, only 23% of the people in the working population age has done a retail lending. And this same number for developed countries is roughly 60 to 70%. So both in terms of percentage of GDP or the population, we are still under-leveraged. NBFCs. Now, the total book size of NBFC is roughly 48 trillion rupees, and the growth has been roughly 17 to 18% for the last 10 years. NBFC basically caters to the unorganized sector, or to the sector where it is difficult to ascertain the cash flow or to get a perfect credit score. So these people use various data analysis, various credit rating filters, and other methods of capturing data, and then they are able to give a loan to individuals or to SMEs and other players where a normal bank wouldn't come and lend. Banks typically, for a salaried person, would want a Form 16C, or for organized sector, they would want your IT returns that captures your total income actually, but that's not really possible in the unorganized sector. That is where the NBFCs come. Now, again, look at FY19. The infrastructure and wholesale loan put together was 45%, and the rest of the retail was 55%. Now, we can see this significant change in the mix there as well. This wholesale and infrastructure has gone down to 31%, and the MSME lending and the MSME part has increased from 16% to 23%. The retail loan has increased from 9% to 18%. So this is the growth which we have witnessed in last 8 years. And if you go by the estimates, the NBFC book, which currently stands at 48 trillion rupees, is likely to reach up to 75 trillion by FY28, 72 to 75, and would the with a slight more increase in the MSME and the retail loans category. I'll just tell you why people go to NBFCs despite still at higher rates. These rates are typically 3 to 4% more than the banks, because these MSMEs, retail people and other people, auto finances, they are borrowing from the local money lenders at a much higher rate, upwards of 20%. So even if these NBFCs charge 16, 17% or 15, 16% from them, they are better off. That's why these people tend to go more towards MSMEs. Now, this is a big opportunity. If you look at, there was a marked shift in the behavior during COVID times. There was access to cheap data, and from 2017-18, the entire broking industry changed. If you look at earlier, most of the brokers, for anybody who had to place a transaction, he had to either call the broker or place an order through the computer. But as these brokers came in the apps, the entire industry was gamified. Gamification of the capital markets and access to cheap data, advent of the smartphone, or the mass advent of the smartphone, that helped the entire capital market industry. From 4 crore demat accounts, we straight away jumped to roughly 19 crore demat accounts in a span of 6 years. That's like a 5x growth in 6 years. And we are a population of roughly 140 crore people, give or take. We are just 14% penetrated in terms of demat accounts. Now, if you look at the chart on the right-hand side, out of 20 years, for 15 years, I had talked about that financialization of the savings would happen sometime. But again, from FY20, the behavior totally changed. The people realized that instead of going for an FD where the interest rate was much lower, you could hardly beat inflation, there is something known as an equity markets or a mutual fund where you park your money and you don't have to be bothered about how the fund is, you don't have to be bothered about the safety of your savings. You can make good amount of money. Now, if you look at in FY20, roughly 4% of the annual financial savings went into the mutual fund. Today, it is roughly 23% of the total financial savings is going towards MFs and equities. Now, at the same time, in FY20, the total AUM of mutual funds was roughly 21 lakh crores. Today, we are sitting at 80 lakh crores and growing. And I believe that this is the industry which is well poised for growth for next another 20, 25 years, because we have just seen the 10% of the tip of the iceberg. We haven't yet seen the tip of the iceberg. We have seen just the 10% of the tip of the iceberg. This is the growth which is possible for the capital market industry. Now, if you look at the insurance penetration again, we were just 2.7% of the GDP in FY02, and currently we are less than 4% in terms of penetration as the percentage of GDP. Per capita insurance premium, we are paying one of the lowest in the world, is less than $100. That's roughly $95. And whereas if you look at both the developed market or the developing markets, China again is at 4% of the GDP, but there the premiums are very high, roughly $500 annually. And if you look at Malaysia also, which is the developing market, the insurance penetration is 5%. Thailand is again upwards of 5%. So we haven't yet caught up with our developing counterparts. And if you look at USA, which is the only developed counterpart which we have taken here, the insurance penetration is roughly 12%. So if you see, we have a long, long way to grow in the insurance industry as well. If you look at the total number of players in the insurance industry is roughly 61, and it is still growing. So you can easily say that the pricing is very competent, very competitive. It is only the people who needs to be told about that life insurance. There is a product called life insurance, which exists to cover the risk. And currently, we are the 10th largest insurance market in the world, and is projected to grow to the 6th largest market by 2032.
That's great to hear.
So if you look at why we are positive on fintech also. Now, if you look at currently, there are roughly 85 crore people who are using internet. And this number is expected to grow, which is roughly 59% penetration. And this is roughly likely to grow to 112 crores in the next 5 years. And that will be roughly 75% penetration. So the active internet penetration is even lower. People have access, but they use it once a while. Active internet user base is roughly 40%, and it's likely to increase day by day, going up to 65%. And UPI transactors, when I count UPI transactors, even if someone has done a 10 rupee transaction, is known as a UPI transaction, that is 30%. This will take a significant jump, and that will increase to 55 to 65% in the next 5 to 10 years. And we can see a lot of infrastructure development going behind the scene in the banking sector and BFC sector, which we do not know. And there will be a lot of players who are coming in here. And that's why we continue to be positive on fintech companies as well. So I'll just briefly touch upon the investment philosophy before I talk about the ELSS fund. We conduct forensics for all the companies, especially the mid-cap and small-cap companies, whichever we get on board. And we look at data and qualitative aspect beyond the annual report, beyond the financial statement analysis, which we do. There are a lot of softer aspects, key material party transactions, auditors, and whatnot. So, and this takes time. And once the company has ticked all the boxes, then we get it into our universe, an investment universe. And post that, it's on a regular basis. We have to monitor the company. And firstly, if we talk about, we do not chase stocks. We maintain both buy and a sell discipline. We buy only those stocks which are trading at least 15 to 20% lower than the intrinsic value, maybe lower. It all depends the intrinsic value or our appetite for profit. All depends upon the size, the nature of the business, and the market cap and the risk involved. And we sell when we think that the investment thesis is broken or the stock is quoting substantially above its intrinsic value. We are investment style agnostic, whether it is growth, value, quality, or anything. For us, a business which has a long runway for growth, generates return above cost of equity, and has got strong operating cash flow in line, which is in line with the profits, is the where we invest. In a nutshell, strong ROE, cash flow, and PAT is the holy grail, and above that stands the management quality. As I talked about, since Trideep has covered the themes, I'll be skipping it, and I'll be moving straight away to the Edelweiss ELSS Tax Saver Fund. I've been managing the fund for last 2 years. The current AUM is roughly 450 crores. We do not take cash calls. We are mostly fully invested with some percentage left for, with some percentage in cash for our daily requirements. Now, about the portfolio positioning. We are overweight on financial services. Within financial services, we are overweight in capital markets, NBFCs, PSU banks, and mid-sized private banks. We have got underweight position on large private sector banks. Again, we are positive on IT, healthcare, and autos mostly, and we are underweight on FMCG, commodities, consumer services. Yeah. Now, as I said, these are the top holdings of the portfolio. Now, if you look at the chart on the right-hand side, the EPS growth of the portfolio for both 26-27, then the ROEs are strong at 17-18%, ROEs are above 20%, and we try to maintain profit growth above the benchmark and ROEs above the benchmark, so we are able to perform above the benchmark. So if you see in last 1 year, most overweight calls have paid to our as per our expectations. Financial sector was the best performer with 5% returns, and we were all also overweight on the financial sector by roughly 5%. As we said, if we see a long runway in capital markets, lenders, and we had a higher exposure there, which I'll be covering the next slide. And luckily for us, that call paid off. Some names to talk about: BSC, Muthoot, State Bank of India, MCX, Karur Vysya Bank. All these names we had in the portfolio, we were substantially overweight. And that's why, and that is how they were able to generate return for us. Now, if you look at HDFC Bank, we were underweight, and being underweight on HDFC Bank helped us generate returns. Coming back to the earlier slide, we were underweight on services, FMCG, metals, minings, oil and gas, and consumer services. And except for one of the stocks and services, the rest of us helped me in making money. The last slide, I'll talk about the performance. I started managing the fund since October 2023. As in 30th November, on direct basis, the fund has generated alpha on 1, 3, and 5-year basis. While on regular basis, the fund has generated alpha on 3-year basis, and the fund is of roughly 55 basis points. And on 1 and 5-year basis, it has underperformed by 70 to 80 basis points. Excuse me. On SIP basis, the on SIP basis, the fund has generated alpha on 1 and 3-year basis. We need to catch up by roughly 20 to 50 basis points on a 5-year and 10-year period. As of 30th November, the fund was ranked in top 5, both on 3 months and 6 months basis, and in top 10 on yearly basis, whereas in a 2-year and 3-year basis, we are in the second quartile and catching up. Yeah, that's it from my side. I'm open to questions now.
Hi, everyone, and thank you so much for being with us. Thank you so much, Trideep and Ashwini, for being so elaborative in terms of your views and on the next leader that we see in the financial services as a sector. A couple of questions, very interesting questions we've got from the audience today. We'll try to cover as many questions we can over the next 10 to 15 minutes. So the first question is for you, Trideep. Uh, while overall you have sounded quite optimistic on the markets after probably a volatile 2025, uh, people want to understand what's your view on mid and small cap segment in particular. I think so after 5 years of consecutive outperformance, in last 8 to 9 months or probably last 1 year, we have seen a bit of underperformance, but still valuations are where they are compared to large caps in the mid and small. So your views on that?
Sure. Um, the positivity that I have for next year is more calibrated in the sense that as long as we do get into a trade deal coming through in the next few months, certainly India would be doing well. But at the same time, if we don't have any trade deal or people play around with economics for a bit too long, then I think the economic circumstances could be quite dire. Would be one risk item which I probably didn't cover when I talked about, and hence I wanted to cover. Mid and small caps. It's clearly most controversial part of the market, isn't it? Some people love it, some people hate it. Um, you know, um, um, I would say that what we've been saying overall in terms of our market view, that avoid the two extremes, which is having a pure large cap exposure or a pure small cap exposure in the two sense. If your view is 3 to 5 years, 5 to 10 years view, or everything kind of is good, hunky dory. The reason why I have been saying so is in the large cap there are some business models which are ceding market share to more new ways of doing business or new business models coming to the forefront, and that's kind of impacting the performance of the same. Likewise, on the small cap side, the incidence of earnings downgrades have been a bit too much. And they have not really come up the ladder with regards to earnings upgrades for them to really perform overall. So net, we have been saying that stick in the middle, which is funds like a flexi cap or a multi cap or a mid cap, but don't go to the extreme. That's one way of from a fund recommendation point that I would say. When I say large cap oriented, it could be flexi cap or large and mid cap. People slightly higher in the risk spectrum could be multi cap and fund, and people who have a slightly higher risk appetite will be on the mid cap side without going all the way to the small cap side. Now, our view kind of remains pretty much the same, that overall, given that the macro uncertainty is still there with regards to the trade deal dynamics, the currency volatility and all the likes of it, the two extremes is something that one should be avoided. If that be the case, then in the last year or so, mid cap valuations have come off from being about 30% premium to 10-year average to now more palatable, 10 to 12% premium to 10-year average. So more palatable than what it was earlier. We still think that some of the best business models with regards to growth, adjusted for the risk, lie in the mid cap domain. And hence, if an investor's outlook is 5 to 10 years and they have a bit of patience to live through the drawdowns, then mid cap could be one of the stronger categories in the market to kind of participate in. And now the data speaks for itself. If you look at over the last 1 year, large caps have seen an earnings downgrade of about 1 to 2%. Small caps have seen downgrades of about 5 to 6%. Against that, the mid cap as a category has seen an earnings upgrade of about 0.5 to 2%. So relatively, what we have been saying about in a more verbose way has played out in numbers as well. And I think the economic environment hasn't changed to that effect. So my view remains the same, Niranjan.
Got it. On the overall market, Pradeep, while we have seen time correction, and as you mentioned, there have been pockets where there has been also a valuation correction. So, for someone who wants to invest, whether it is in mid cap or small cap, or on the other end, flexi cap and multi cap, what do you suggest? A lump sum approach? Because this is always debated, right? A lump sum or an SIP, while it is a question of your own cash flow. But if someone has the choice to make that uh, to invest right away or stagger it over the next 3 to 6 months, what would you suggest?
Beyond a doubt, it will be STP.
Okay.
And I'll be very straight with regards to my view overall. I again partly alluded to the risk item. But I mean, in all honesty, of course, we are equity investors. We are bullish and all that. But if we anniversary this the tariffs that the drama that we've been seeing for the last almost year or so, since March, April, then I think that is when the time, in my opinion, where economics take over. And if you look at current US tariff to the rest of the world, it's about 17%. The last time when the tariffs were at these levels were in 1930s. So all of us working history wise don't go back that as much. So the playground becomes quite new, and even we look like kids, even though I have 25 years of history. And hence I would advise that investors who are looking to allocate capital at the current levels certainly do so in an STP basis, because over the next 3 to 6 months, this risk or reward, whichever way it turns out to be, reward, if we do get a deal, then there will be some sort of a relief rally. If we don't get a deal, then the consequences of the same with regards to budgets, thinking of clients, and the business circumstances will be evident in the next 3 to 6 months. So in all probability, STP is the way forward, particularly in the next 3 to 6 months in the current economic scenario. Niranjan?
Thanks, Videep. Ashwini, couple of questions to you on financial services. You covered the sector in great depth. Uh, Today, as we see, financial services is not only about lending. Probably 10 years back, a large part of the market was only available, especially in the listed space, in the lender side. Today, there is capital market play, there are wealth managers, and many other plays. So if you divide this into sub-segments, where do you think within financial services the opportunity is more pronounced and more appealing, and in which pockets you think the opportunity is fairly over and could be overrated?
If you look at, I would straight away look at the runway for growth for any of the sectors. So if you look at the financialization of savings have happened in India in only last 6 years, post 2019, post 2020.
Mhm.
So, and if you look at overall capital markets, overall mutual funds, we are roughly at 80 lakh crores, which is roughly 20% of the overall GDP. But whereas in developed markets, that number is upwards of 150%. So definitely, a capital market play is one of the plays that I would really like to have in my portfolio, or I think would continue to grow for next 2 decades. Secondly, NBFCs. There is a huge population in our country who do not have access to formal money lending in terms because they do not have the Form 16Cs of the world, or they don't have a proper income tax return filing. And because of all these things, this is where the NBFCs come in, and they lend maybe at a slightly higher yield as compared to the banks, but they are catering to the mass need. So I think these two sectors are there for long-term growth, which where I can see a long runway. And if you look at PSU banks as well, all the problems that PSU banks had in terms of asset quality, or in terms of people, government has done a lot. The banking board has done a lot in terms of defining the profitability for banks, the requirements to become an ED, MD. So all these things have been taken care of. So I think these three areas do have a long runway for growth along with insurance.
So, Niranjan, let me just add a couple of context to this financial services as an opportunity. In my opinion, financial services today, as it stands as a sector, is second to none. It comprises close to about somewhere between 30 to 40% of any index that you look at it.
Yeah.
And it's a fairly broad-based sector, and it was not always this way over the last 30, 40 years.
Yeah.
If you go back 30, 40 years when we started investing, it was a monolithic basket of only lenders coming through, and to even corporates, the only way that somebody could get credit to was if your rating is great, and you would go to bang the doors of HDFC Bank or ICICI Bank or some of these big banks, and that's your only way to credit. It was a credit-starved economy India used to be about 20 to 30 years ago. From there, we've come a long way. These are various stages of disintermediation that have sort of happened, where today, from loans can be disbursed while doing a due diligence online through your CIBIL score, and lending happens, peer to peer, or even on an online basis without even going to the bank. So, starting from going to the bank to the ATM to finally fintech, it's been a huge journey that India has kind of made. And without having gone through the history of developed markets, which kind of have a whole bunch of baggage together, today the new generation financial services entrepreneurs and the financial services business models have a lot to sort of improve upon and work on. And that's why what we are seeing in some of the new listing, a whole bunch of fintech entrepreneurs have come about who are now nibbling away a bit of market share on the periphery from the traditional banks. And that's the reason, if you look at it, today when we decompose the credit growth in the economy, right, while bank lending will do what it will do, but there are other aspects like Ashwini explained, the NBFC lending, the fintech lending, all these parts have sort of come about, which adds a lot to the credit starved economy of India, with cost of capital about 12 to 13%. This intermediation and these sort of multiple entities coming in the financial ecosystem was very much needed. And as you know, that ultimately a financial services sector is a capital allocator within the economy.
Yeah.
What risk category money comes in, which risk category the money goes to, is decided effectively by the financial services sector. Now, these other elements like capital markets or insurance or different fintech players that they have come in, they have addressed the different risk spectrums of lending, which was earlier only limited to the conservative bunch of projects financed by the entrepreneurs. So the risk-taking ability of the entrepreneurs have gone up significantly as the financial services sector has expanded over the last 30, 40 years. Something of this kind of, this trend or this change is what we are looking to play in the context of this financial services fund, where there, of course, will be the traditional lenders. But there will be the market share gainers who will play an important role in the lending landscape going forward. And some of the categories that Ashwini mentioned, which is a structural part of the financial services sector, will actually gain prominence. Today, those same lenders would be roughly about 2/3 of the lending, or the over the financial services sector, something that used to be 100%. So they have ceded market share to the new business models. The other trend which has happened is basically from PSUs to private. A lot of trend migration or value migration has happened from the PSU banks, which used to lend very conservative set of products, a conservative set of customers, to a more private sector oriented lending, which has happened from this way. So I encourage through yourself and the investors, the financial services sector is a world in itself. And the way it is growing is something worth looking for and getting in double clicking and understanding the individual segments as well.
Yeah, thanks, Pradeep. While we are on sectors, there are multiple questions, so I'll try to bunch up and have your quick take on these sectors. One is IT. Is it a contra view? Because someone has seen our portfolios, and across your portfolios, you're fairly, overweight compared to peers, and probably slightly overweight compared to benchmark as well. So, your view on the IT sector, and on the other hand, your view on how are things in the defense space, and semicon or industrial space, and lastly on metals, these three sectors.
Okay. What else remains anyway?
Absolutely.
So, yes, we have been contra. Arguably, we have been a little early, quite frankly. No one can get these timings exactly overall. But I would say this, that 2025 has been a year of anti AI, or has been a year of AI and AI beneficiaries. And if you look at our country as in India, and IT services as a sector is today seen as an anti AI trade. Now, where exactly, as Howard Marks describes, the pendulum of pessimism is the highest, it's very kind of difficult to exactly pinpoint, but we broadly know that we are at the most pessimistic or somewhere close to that on the IT services sector. And that's where we want to broadly be. So, hence, as you rightly pointed out, that versus benchmark, we may not be massively overweight, we may be marginally overweight, but versus competition, versus important segments, we are there or thereabout. We certainly think that the earnings from a bottom up standpoint are fairly decently cooked at this point in time. There's no big risks coming about in this spectrum. Order flow has been weak. Macro conditions, including H1B concerns and whatnot, has been decidedly negative. In all of these circumstances, the contra bit in us makes me feel that it's time to gradually take a more constructive view, even though give it a bit of time to play it itself out. And yes, in that context, you're right that we have been contra and we want to stick about this way. The second sector you mentioned was
It's basically defense and
defense. Yes.
yeah.
Defense, we have been structurally, positive, and we continue to remain the same. Same. Occasionally, one aircraft hitting the ground sometimes hits the share prices as well. We fully understand that, but our defense story is a lot more than that. Our defense story is not just about defending our own country, but also, from what I gather, is about India being an outsourcing destination from defense. So it's a multi-year opportunity. We kind of take when the markets are swinging high on defense side positively, but equally when it corrects, gradually allocate position. The issue in defense, honestly, Niranjan, is there are not many listed stocks to really kind of express this opinion in a meaningfully overweight way. So we are calibrated overweight in this space. We continue to remain so and evaluate new opportunities in this space as well. Third is on metals, I think.
Yeah.
I think metals, we have a tactically positive stance, if I may use that word. Overall, we do think that given what's happening in terms of the global change of power, the paper currencies or turning out to be fiat currencies, and there is a risk that there might be devaluation of paper currencies. In that scenario, real assets, real assets, precious metals, and sometimes commodities could see a better days ahead. And hence, keeping that in mind, we are probably neutrally to marginally overweight the right segments of the metals, I would say. It's not a big position in the portfolios, but tactically we play that stance more than anything else. Our broad view on oil and gas or on crude oil, etc., is negative. But within that, metals and mining, specifically when we see opportunities, we are positive on. Hopefully that covers all the sectors.
Oh, very well covered, Trideep, given the time constraint. Last question, because we have just 3 minutes left, and we have covered a lot of ground. Unfortunately, we won't be able to take all the questions. So all the audience who have sent your questions in some way will try to answer them. But last question for you, Trideep, on the FI flows. Uh, FI has been continuously selling while domestic inflows have held up the market. Uh, but it also shows how international investors see India. So, what has been the concern area, and what do you think will correct this flows trajectory?
I am a big believer that markets are followers of earnings. Over a reasonably long period of time, which is more than a year, broadly markets gravitate to what earnings do. Over the last year or so, if you look at India's earnings estimates, we have seen a cut of anywhere between 10 to 12%.
Hmm.
Why blame the FIIs? Overall. So, very clearly, we have to kind of get back on the earnings upgrade cycle. And hence, I highlighted that we have seen the early signs of it. If it continues, not only FIIs, you will see money flow coming from various different parts of the world as well. Also, I think the second part which I would add is currencies. The volatility in currencies with regards to a dollar and the rest of the world also makes a difference to their view because most of them are benchmarked to dollar. And hence, in times of dollar strength, they tend to go back and then calibrate that exposure. So you've got to build that in as well. The third element that I would highlight is in particularly calendar year 25, AI and AI beneficiaries did well, none of which we are kind of a big player on. And hence you saw a money flow outside as well. As 2026 unfolds, there is a decent chance that the anti-AI trade comes into vogue, in which case things might be better. Finally, FIIs are just about 16% of the market. So pat ourselves on the back that people like yourself have done a great job attracting flows onto DIIs. And as that becomes a meaningful part of the market, we, I think, can sustain this volatility. And as long as the earnings come through, we have better days ahead with regards to markets. Niranjan?
Thanks so much, Trideep and Ashwini. But I will not let you go, Trideep. One last, uh, you know, uh, suggestion or your view for investors and distributors in 2026. If you were to give probably 2 to 3 lines which they can take away from this entire 1 hour segment, what they would be?
Think about asset allocation in two parts: one that drives return, one that thinks about protection. Um, for driving returns, the best way to drive returns today is beat inflation, which is equities. And for driving protection, the best way to do that is precious metals or real assets.
Thank you so much, and thanks everyone for joining in such huge numbers actually. And I'll take this opportunity to wish you a great 2026, Happy New Year, and a great festive season ahead. Thanks again, Pradeep and Ashwini, for wonderful.
Thanks.
Happy investing, everyone. Cheers. Bye bye.
Thanks a lot.